Right guys, so let us start on with revision of accounting standard 11, the effect of changes in foreign exchange rate. As usual, first we'll cover up the contents of the standard and then we'll move on to certain very important practical questions. Basically AS 11, the effect of changes in foreign exchange rate, is applicable on those enterprises which in some ways have exposure to foreign currency transactions, or they are having some operations in some foreign country, or they are having some forward exchange contract. So this standard basically gives us guidance to deal with three particular items. One, for accounting for transaction in foreign currencies, translating financial statements of foreign operations, and for accounting for forward exchange contract. We'll cover things one by one, but before getting there, we'll first look at some very important definitions which will be useful while we are doing these three topics. First, let us understand what is reporting currency. Reporting currency is the currency in which we make our financial statement, right? The currency in which an enterprise prepares and presents its financial statement is its reporting currency. So if my enterprise is making its financial statement in Indian rupee is the reporting currency. If my enterprise is making its financial statement in US dollars, then US dollars is the reporting currency. The currency in which the financial statements are made is the reporting currency. Then exchange rate. Exchange rate is the ratio of exchange between two currencies. For example, let's say to get $1 US, if I need to pay 75 rupees, then the exchange ratio between the dollar and the rupee is known as the exchange rate. Then foreign currency. Foreign currency is any currency other than the reporting currency. For example, my company is making its financial statement in Indian rupees, then other than Indian rupees, any currency from the perspective of my company will be a foreign currency. If my company is making its financial statement in US dollars, then any currency other than the US dollars will be treated as foreign currency. The foreign currency is a currency other than the reporting currency of the enterprise. Then we'll understand what is average rate. Average rate is basically the average of foreign exchange rate of a particular period of time. Then we'll understand what is closing rate. Closing rate is the exchange rate which is there on the balance sheet date. So India, we prepare financial statement on 31st of March, right? That is the year end date. So the exchange rate which is there on 31st March will be treated as the closing rate. But if you are preparing financial statement on 31st December, the rate on 31st December will be treated as your closing rate, right? So the exchange rate on the balance sheet date will be treated as the closing rate. Then we'll understand what is exchange difference. Exchange difference is the difference which is resulted from reporting the same number of units of a foreign currency at different exchange rates. For example, let's say I purchased certain goods on 23rd of March 2020, right? Maybe I have purchased goods worth $10,000 and on that day the exchange rate is 75 per dollar. Then, right, then this transaction in the Indian rupees will be 7,50,000. Then when I make my financial statement on 31st of March 2020, I have to restate this $10,000 at the closing rate, which is the rate on the balance sheet date. For example, let's say the rate on the balance sheet date is 77 per dollar, right? So now my liability in relation to purchase of these goods becomes 770. The difference, right, between these two will be treated as an exchange difference, right? The difference resulting from reporting the same number of units, right? Reporting the same number of units of a foreign currency in the reporting currency at different exchange rates. So $10,000 have been reported once on the date of the transaction when the exchange rate was 75. Again, it has been restated at the year end, which is 31st of March. Right, and this exchange rate on that date is 77 per dollar. So difference between these two rates into the amount of foreign currency will be treated as my exchange difference. Then monetary item. Monetary item means money held, which we are talking about liquid cash. Either it could be cash in hand or the money which is lying in a bank account. And assets and liabilities to be received or settled in known or determinable amounts, right? Money held and assets and liabilities to be received or paid in fixed or determinable amount of money. So when we talk about money held, it is the cash in hand or the money which is lying in our bank account. When we say assets and liabilities to be received or paid in known or fixed or determinable amount of money, we are talking about those assets and those liabilities where we know for sure what is the amount of inflow and what is the amount of outflow. For example, our debtors, we know how much money exactly which we have to receive from our debtors. Our bills receivable, we know how much of amount which we are supposed to receive from our bills receivable. Similarly, if we talk about liabilities, loan taken, we know how much amount of loan has been taken and how much we need to repay. Similarly, creditors, expenses payable, we exactly know that how much is our liability towards these parties. So these will be treated as monetary item. Then we'll talk about non-monetary item. These are assets and liabilities which are not monetary item, right? Basically, in this category, there will be three items. One which is our fixed asset, other which is our investments in equity shares, and third which is stock. See, in case of PPE, which is our fixed asset, we don't know how much exactly these items will realize. When we'll actually go and sell it in the market, at that point of time, we'll get to know how much money will be realized. Similarly, in case of investments in equity shares, the prices of equity share changes continuously, and at the time of executing the transaction only we'll get to know what is the exact amount which it has fetched. Similarly, in case of stock, we can only estimate the NRV, but when it is actually sold, right, that will be the price which will be determined at that point of time. So these three will be treated as non-monetary item: PPE, investment in equity shares, and stock. Then we'll talk about the first topic. See, we said that this standard will give us guidance in relation to three topics: accounting for transaction in foreign currencies. Then it will talk about translating financial statement of foreign operations, and then it will talk about forward exchange contract. We are starting with the first topic, which is accounting for transaction in foreign currencies. Let us first understand what do we mean by a transaction in foreign currency. Transaction in foreign currency is a transaction which is denominated in or which requires settlement in a foreign currency will be treated as a foreign currency transaction. When we say that a transaction is denominated in foreign currency, that means the principal value of the transaction is in foreign currency. Maybe we have purchased certain goods and the invoice is in USD, right? Then that transaction is denominated in foreign currency. Or maybe there is an asset or there is a liability which is there, right? In relation to that asset, the money which we will receive will be in foreign currency, or in relation to that liability, the money which we will pay will be denominated in foreign currency, right? So foreign currency transaction is a transaction which is denominated in or requires settlement in foreign currency. And if we talk about example of these transactions, any transactions, right, which are denominated in foreign currency or maybe which requires settlement in foreign currency will be treated here. Means when we purchase goods, when we sell goods, when we take loan in foreign currency, when we lend to somebody outside India, and that will be treated as foreign currency lending. When we become party to an unperformed forward exchange contract, what is forward exchange contract we'll understand a little later. Or any other asset or a liability which is to be received or is to be paid in foreign currency will be treated as a foreign currency transaction. Now we'll talk about the accounting aspect of it, that how do we account for transactions which are denominated in foreign currency. For example, let's say I make my financial statement in Indian rupees. I purchase certain goods worth $10,000, right? I cannot make an entry in my books of accounts in dollars. I have to convert that $10,000 into the Indian currency to enable me to make an entry into my accounting system. And primarily this standard will give us a guidance that how do we need to convert this foreign currency amount into the reporting currency and do the accounting in the books of accounts. So whenever we talk about these foreign currency transaction, there are two things which we primarily deal with. One, which is the initial recognition. Initial recognition would mean that first time when the transaction has taken place, right, we record it in the books of account. This is normally done on the date of the transaction, and then till the time the transaction is settled, we need to restate this transaction at each balance sheet date. So how this restatement of foreign currency transaction will be done in our financial statement. So first we'll talk about initial recognition. That initial recognition means recording the transaction for the first time in our books of accounts, right? We will have to record obviously in our reporting currency, because if our reporting currency is Indian rupees, we cannot record a transaction in which is denominated in dollars in our books of accounts. Therefore, in the reporting currency, right, obviously we'll do accounting in our reporting currency. And how that will be computed? That will be computed as $10,000 into whatever is the exchange rate of INR and dollars on that date, right? So in the reporting currency, computed as foreign currency amount, which is $10,000, into the exchange rate at the date of the transaction, right? Whatever is the rate on the date of the transaction, we'll use that rate to convert the dollar into INR. But for practical convenience purpose, you can take an average rate, right? A rate which approximates the actual rate, that is the average rate for a week or a fortnight, etc. But this can be done only when there is no significant fluctuation in the exchange ratio between these two currencies. Otherwise, if there is a significant fluctuation, then the use of average rate is prohibited. Only when your foreign currency rates are very stable, right? Only in that circumstances you can use an average rate. Otherwise, you're supposed to use the exchange rate which is there on the date of the transaction. Then we'll talk about reporting at subsequent balance sheet dates, right? So the treatment depends upon whether the foreign currency item is a monetary item or that foreign currency item is a non-monetary item. If your foreign currency transaction or the item is a monetary item, at each balance sheet date you need to restate them at the closing rate, right? You need to restate them at the closing rate, right? Rate at on the date of the balance sheet is the closing rate. You need to restate it at the closing rate. But if your foreign currency item is a non-monetary item which is carried at historical cost, normally we can talk about PP, right? Or which is carried at fair value. We know under AS 10 we have an option for PPE to be carried under revaluation option, and this revaluation is basically the fair value. So if it's a foreign currency non-monetary item carried at historical cost, you have to use the rate on the date of the transaction. So maybe I purchased my fixed asset 5 years back, right? Even if today at the balance sheet date when I have to convert that item, if it is in foreign currency, I will use the rate which I had purchased and the rate which was there 5 years back when I purchased that fixed asset. Similarly, in case of fair value, I need to use the rate, right, which was there when that revaluation activity was done. So in relation to non-monetary items, we don't restate these non-monetary items at each balance sheet date. We use the rate which was prevalent when those non-monetary items were first recognized in our books of accounts, right? So by this what we get to know that there will be a foreign currency difference, right, in case of monetary item. But please remember, very, very important, that in case of non-monetary items, right, there will be no foreign currency difference because these foreign currency, these non-monetary items are not restated at different rate. They are carried in our balance sheet at the rate on the date of the transaction, right? Now, then it says that if there is a restriction on remittance or maybe the closing rate which you are getting is not reliable, right? Basically the concept behind recording the assets and liabilities in the balance sheet is that they should reflect the amount receivable in case of the asset and the amount payable in case of the liabilities. So if the closing rate is unrealistic, right, it will not predict or it will not specify the receivable amount of the asset or the payable amount of the liabilities. In that case, the standard says you should record the asset and the liabilities at the value which you expect these items will be settled at the balance sheet date. Now, let us talk about the exchange differences, right? Basically, let us talk about the exchange differences, right? What are these exchange differences? The exchange difference is reporting the same number of units of foreign currency, right, at various different rates on different dates, right? That is the exchange difference, right? So, exchange difference on monetary item, we have already concluded that there will be no exchange difference on non-monetary item because for non-monetary item, we use the rate on the date of the transaction or the rate on which, on the date on which the fair value are taken, right? So you're not changing the rate consistently, so there will be no foreign currency difference. So in case of monetary items, see, the normal treatment of exchange difference in case of monetary item is that you take the exchange difference, whether it's a profit or it's a loss, to your statement of profit and loss, right? But under AS 11, by virtue of para 46 and 46A, right, there is a separate treatment also specified which we'll look into, right? So exchange difference on monetary item, option under 46A not availed, that is you are following the normal treatment, right? It says that exchange difference on both, listen to this very carefully, exchange difference on both long term and short-term foreign currency monetary items be recognized as income or expense in the statement of profit and loss, right? We have already discussed for non-monetary item there will be no exchange difference, right? In case of monetary item, be that monetary item be long term, be that monetary item be short term, the exchange difference will be taken to statement of profit and loss. But AS11 provides with an option, right? Option under para 4646A availed. First, remember very carefully that this option is available only for long-term foreign currency monetary item. That means if your monetary item is a short term, listen to this very carefully, if it is a short term monetary item, right, the only treatment is that the exchange difference should be taken to statement of profit and loss. Option under 46 and 46A is available only for long term foreign currency monetary item. So if you avail this option, it is available only for long term. If you don't avail this option, the normal treatment is that exchange difference on both long term and short term monetary item is to be taken to statement of profit and loss. For short term monetary item, it will always be statement of profit and loss, but if it is a long term foreign currency monetary item, please listen to this very carefully. If it is a long-term foreign currency monetary item, then you have an option either to go for a normal route or you can choose to avail option under para 46 and para 46A. So option under 46A available, it is available only for long-term foreign currency monetary item, and it's a irrevocable option. Once you choose this route, you cannot go back to the normal route. Exchange difference arising on long-term monetary item, if it is related to acquisition of depreciable capital asset. For example, you have taken a loan in foreign currency, and with the help of the loan in foreign currency, you purchase certain fixed asset which is of a depreciable nature. Need not that you need to import that fixed asset. Listen to this very carefully. I took a loan from US, right, and by using that loan, I purchased certain fixed asset. So in this case, I have taken a foreign currency long-term monetary item, maybe the loan is for maybe 5 years, and with the help of this loan I have purchased certain depreciable fixed asset, right? So related to depreciable capital asset, example, loan taken for acquisition of plant and machinery, right? The normal treatment of exchange difference is that you will either debit it or credit it to the statement of profit and loss, but in this case, the exchange difference is added or deducted from the cost of the asset and should be depreciated over the balance life of the asset. So whatever is the exchange in the normal route, if it's a loss, you will say profit and loss account debit to that particular liability. But if it's a long-term foreign currency monetary item, and if you are availing option under 46 or 46A, then your entry will be your fixed asset account debit to your long-term foreign currency loan account. And then that fixed asset will be depreciated over the remaining useful life. In other case, means it's a general purpose loan, the long-term monetary item is not relating to a depreciable capital asset. Then in that case, you need to accumulate in a foreign currency monetary translation difference account, which we normally call as FCMITDA account, and amortized to PL over the balance life of such asset or liability, right? So maybe you have taken a loan for 5 years, and if that loan is a general purpose loan, any exchange difference on that loan will be accumulated in FCMITDA account, and it will be charged off to PL over the period of loan. So basically this option is to defer the PL charge or the PL credit. Under the normal route, any exchange difference on its inception will go to the statement of profit and loss, but in this case it will be deferred. First it will go to the value of the asset if that long-term monetary item is in relation to depreciable asset, or it will go to FCMITDA account if it's for a general purpose asset, and based on the tenure of that asset or maybe based on the tenure of that particular loan, it will be charged off to the PL. Now let us take certain example, right? But before example, let us talk about few things about this para 46 and 46A. To exercise 46 and 46A, an asset and liability should be designated as a foreign currency monetary item. It should be designated as a long-term foreign currency monetary item. And what is this long-term? that it has a term of 12 months or more from the date of its origination as an asset or liability. So it should have a tenure of 12 months or normally the same criteria which we use for non-current assets and non-current liabilities. Disclosure is to be made that you have exercise the option under 46 or 46A. Any contingent liability should be converted at the closing rate. Now let us look at certain examples under the normal scenario, right? First we'll look at certain example under the normal scenario and then we'll take certain examples under 46, 46A as well. Let's say on 24th of September 2019, purchase 10 laptops at $5,000 per laptop from Dell Corporation US. The payment was made immediately and the exchange rate on this particular date on which you have made a purchase is 75 per dollar. So it's pretty simple. You are purchasing an asset in and the amount is denominated in foreign currency and making immediate settlement. So on 24th of February 19, we will say laptop account debits to, we will say, bank account because the settlement has been made immediately. We have purchased 10 laptops. Cost of one laptop is $5,000 and the exchange rate on this particular day is 75. So basically $50,000 into 75. This gives me 37,50,000 is the transaction. In this case, see, there is no exchange difference. Why is there no exchange difference? Because the transaction has taken place and has settled on the same day, right? We don't need to report the same number of units of foreign currency at two different rates. Let's take another example. On 24th February 2019, purchase 10 laptops at $5,000 per laptop from Dell Corp US. Payment was made on 24th March. So you are purchasing on February 24th and you are making the payment on 24th of March after a month. On 24th February the rate was 75 for a dollar and on 24th March after 1 month the rate was 77 per dollar. Now let's see how this transaction needs to be recorded and what will be the treatment of foreign exchange. So on the date of the transaction, which is 24th of February 19, we will say laptop account debit and we'll create a liability for Dell Corp US, which is basically 10 laptop into $5,000 per laptop into rupees 75 per dollar, which is the rate on the date of transaction. So this will come out to 37,50,000. This is 37,50,000. Then on 24th of March 19, we are making the settlement. So we'll say Dell Corp US account debit, right? We'll debit it by 37,50,000. Right? We'll say to bank, right? The amount which will go from our bank account will be 10 laptops into $5,000 per laptop into the exchange rate on the date of the payment, which is 77. So therefore we will say $50,000 into 77. Right? We'll have to make a payment of 38,50,000. So we had a liability initially recorded at 37,50,000, but we have made the payment, we have made the settlement for 38,50,000. So there is a loss. So we will say foreign exchange difference. This foreign exchange difference is 1 lakh, which is basically movement of $2 into $50,000. 1 lakh rupees is the foreign exchange loss, and this foreign exchange difference will be closed by transfer to profit and loss account. Let's move on to the next example. Let's say on 24th of February 19, purchase 10 laptop for $5,000, right, from Dell Corp. Payment was made on 24th of April. So it is in the next financial year that we are making the payment, because the purchase is made in financial year 18-19 and the payment is made in financial year 19-20. The exchange rate on the date of purchase was 75. The exchange rate on 31st of March is 76 and the exchange rate on the date of payment is 77.50. Now let us see how do we deal with this. And please remember, we are doing this treatment considering that we have chosen the normal route, we have not chosen the route available under 4646A. And here we don't have any long-term monetary item as well, right? Therefore, the 4646A is not available as well. So on the date of the transaction 24/2/19, we will say laptop account debit to Dell Corp US account, which is again 10 laptop into $5,000 per laptop into 75. So this will be 37,50,000. Then at the year end we need to restate the liability. Therefore we will say 31st March 19. Right, the rate was 75 and it rose to 76. So our liability towards Dell Corporation has increased. So we will say foreign exchange difference account debit to Dell Corp US account, right? We have 10 laptops, per laptop is $5,000 and the exchange rate at the year end is 76 and we had initially recorded at 75. So 1 per dollar. So 50,000 is the loss which we are facing because of increase in the exchange rate. This will be closed by transfer to PL, right? Then on the date of settlement of the transaction, which is 24th of April 19, right, we will say Dell Corp US account debit. See, the balance in the account of Dell Corp US is 38 lakh, 37 lakh 50,000 was initially credited and then subsequently another 50,000 was credited in that account, right? So the total amount which is to be there in the Dell Corp account is 38 lakhs. So we'll debit Dell Corp account with 38 lakhs. Then we'll say to bank account, right? We are paying for 10 laptop. One laptop is $5,000 and the rate on the date of settlement is 77.50 per dollar. So we'll say 50,000 into 77.50, which is 38,75,000. So we'll say 38,75,000 and the difference will be foreign exchange difference account. This 75,000 will be debited to the foreign exchange difference, right? So this is how, and this will be closed by transfer to profit and loss account. So this is how normally we do accounting for our foreign currency transactions. Now we'll also have a look at the scenario when we avail this option under para 46 or 46A. Let us take an example and with the help of this example we'll see how does that work, right? So let's take an example. Let's say loan taken on 1/4/2020 $50,000 for purchase of machinery on the same day, right? The loan is repayable after 5 years and the useful life of machinery is, let's say, 10 years, right? Now let's say exchange rate on 1/4/2020 when the loan was taken, right, and the asset was taken, let's say the exchange rate was $1 was 75. Then on 31st March 2021, which is the year end, let's say $1 was 77. Now let us see how do we account for it, right? And we'll look at both the scenarios when 46 or 46A is not availed and when 46 or 46A is availed, right? So write both the scenarios. We'll say 46A not availed, here 46A availed. Please remember, had this loan been for less than a period of 12 months, right? Option under 46A would not have been available because the long-term foreign currency monetary item, in that case only 46A is available. In this case, the long-term foreign currency monetary item, right? Long-term foreign currency monetary item. This loan is the long-term foreign currency monetary item. If this loan was repayable after 6 months, the option under 46 and 46A would not have been available at all. We would have to go for the normal route only, right? Let us do the accounting under both the scenarios, right? This will clarify the entire scenario in front of you. So we'll say on 1/4/2020, we'll say bank account debit to foreign currency loan, because first the money will come into our account. So we'll say 50,000 into, the rate is 75. So we will say 37 lakh. 50,000 is the amount in INR terms which came to our bank account, right? When we are availing this, the first entry would remain the same. So I am doing the same entry. We'll say bank account debit to foreign currency loan account, same $50,000 into 75 is the exchange rate. This will be 37 lakh 50,000. Please follow this example very carefully. Then on 1/4/2020, on the same date, we'll say machinery account debit to bank account. For the purpose of convenience, we could have also done a single entry saying machinery to foreign currency loan, right? And this machinery is also purchased on the same date at the same value. So 50,000 into 75. So 37 lakh 50,000. We will say machinery account debit to bank account 37 lakh 50,000. This is 1/4/2020. Now see, we have already seen that in case of foreign currency non-monetary item, please look at this very, very carefully for a total concept clarity. This loan is a foreign currency long-term monetary item. Please remember, this loan is a foreign currency long-term monetary item. Whereas this machinery is a foreign currency non-monetary item. Absolutely clear, machinery is PPE and this machinery is a non-monetary item. And do we restate machinery? No. Machinery, although it's purchased in foreign currency or with the help of foreign currency, right now we haven't said that we have imported this machinery, but had it been that this machinery is imported, still we would not restate it. We would use the rate of 75 to take it forward in each balance sheet date. Now, since this loan is a foreign currency monetary item, we are not availing the option in the first case. Look at this very carefully. So on 31st March 2021, right, the exchange rate has gone up to 77. So our liability, our payable for the loan has increased. So our entry will be foreign exchange difference account debit to foreign currency loan account. The loan is of $50,000. 77 minus 75, right? So 1 lakh rupees is my exchange loss, and this foreign exchange difference will be closed by transfer to profit and loss account. But in case we are availing the option, right, listen to this very carefully, in case we are availing the option under 46 or 46A, in that case on 31st March 2021, our entry will be machinery account debit to foreign currency loan account, and this $50,000 into 77 minus 75, which is the rate of initial recognition, 1 lakh rupees will be debited to the machinery account, right, and credited to the loan account. So if the option is availed, it will not go to the PL and it will go to the value of the asset. And had this loan be a general purpose loan, not for a depreciable asset, right, we will make an entry FCMI TDA account debit to foreign currency loan account. And now on 31st December 2021, we'll say depreciation to machinery account. And look at the value very carefully. We had capitalized it at 37.50 plus 1 lakh, which is this entry, divided by 10, which is the useful life of the machinery, right? So this is how the treatment will differ when the option under 4646A is taken and when the option under 4646A is not availed. To sum up, if you have a short-term monetary item, listen to this very carefully. For non-monetary item, no exchange difference. For non-monetary item, no exchange difference. If you have a long-term monetary item, right, then you have two options. Either to go for normal route where you will debit or credit your exchange gain or loss to PL, and you have another option for long-term monetary item, which is para 46 and 46A. If it is for depreciable item, right, you will add it or deduct it from the value of the principal asset for which that long-term monetary item is associated with. And if it is not for a depreciable asset, you will accumulate the difference in FCMI TDA account and amortize it over the balance life of the asset or the liability. Clear? Now we'll talk about treatment of exchange difference on monetary item relating to net investment in non-integral foreign operation. We are yet to talk about non-integral foreign operation, but as a heads up, any exchange difference in case of a non-integral foreign operation, we don't take it to the statement of profit and loss. We accumulate it in an account called FCTR account, foreign currency translation reserve account, and when that operation is disposed or sold off, entire accumulation in FCTR account is debited or credited to the statement of profit and loss. So this says that if there is a monetary item, right, maybe there is a receivable, there is a loan in relation to a non-monetary foreign, non-integral foreign operation, any fluctuation on restatement, right, for these monetary items which are related to non-integral foreign operations, you will not take it to the statement of profit and loss, but you will take it to FCTR account. So normally any difference on monetary item is taken to statement of profit and loss, but in this case, if it is related to a non-integral foreign operation, instead of taking it to statement of profit and loss, you will accumulate it in the account which is foreign currency translation reserve account. Now let us come to translating financial statement of foreign operation. First, let us understand that where does this requirement come from. Let's say I am a company, let's say I am Reliance Industries Limited and I am operating from India. I have certain branch offices in Singapore, US, Dubai, Emirates, etc. So these branch are my part and parcel only. So when I am reporting my financial statements, right, I have to incorporate the number of these branches. But if my branch is in Singapore, if my branch is in US, they will prepare their financial statement in the local currency of their region, maybe Singapore dollar, maybe US dollar, etc. When they send their numbers to me, I am making my financial statement in INR. So I need to convert these financial statement of my foreign branch from the Singapore dollar to INR, from the USD to INR. So how that conversion needs to be done will basically be dealt with by this particular section. Let us understand first that what is a foreign operation. A foreign operation is either my subsidiary, my associate, my joint venture, my branch, which is operating, right, which is operating in a country other than the country of the reporting enterprise. So if I am the reporting enterprise, I am domiciled in India. If my subsidiary, my joint venture, my associate, my branch is operating outside India, they will be treated as my foreign operation, right? Foreign operation is a subsidiary, associate, joint venture, branch of the reporting enterprise, mean the enterprise which is making its financial statement, the activities of which are based or conducted in a country other than the country of the reporting enterprise. So I am the reporting enterprise, my country is India. If they are established and operating outside India, they will be treated as foreign operations. Now, these foreign operations are classified into two categories, one which is integral foreign operation, another which is non-integral foreign operation. What is an integral foreign operation? Integral foreign operation, as the word suggests, integral, means it's a very important part of my operations. Non-integral, it is my operations, but it is not such an important part, or maybe it's not so much connected with me. So when we talk about integral foreign operation, right, we are talking about an operation which is just like an extension of the reporting enterprise's operation. For example, I am Reliance Industries Limited, I am domiciled in India, I make a subsidiary in US, and the entire duty of that subsidiary is that I will send goods manufactured in India to this subsidiary, and this subsidiary will sell goods in the local market. So it's just like having another office in US, and that office operating on my behalf. Then maybe let's say I have a subsidiary in Dubai. The operation of that subsidiary is to procure raw material from Dubai, send it to India, and then I'll manufacture goods with the help of it. So it's just like an extension of the reporting enterprise, right? From legal perspective, I have set up a legal entity in those particular region. So let us understand. Integral foreign operation is a foreign operation, activities of which are integral part of the reporting enterprise, carries on business as if it's an extension, as if I have opened an office in another country. Changes in exchange rate between the reporting currency and the foreign currency has almost an immediate effect, right? It will obviously have an immediate effect, because if I have set up a subsidiary in US which is supposed to receive goods from me and sell in the local market, right, and remit the cash back to me, the fluctuation in the USD INR rate will immediately impact me, because the operations are so much connected and these are happening on a daily basis. But when we talk about a non-integral foreign operation, right, it's not integral, means it operates fairly independently. I do not have too much of intervention, right? It is my subsidiary, it is my associate, maybe it's my branch, but I don't have so much of direct connect with it. It is operating fairly independently, it is procuring its own goods, it is procuring its own loans, it is operating in its own market, and there is not too much exchange transactions between us on a daily basis, right? So non-integral foreign operations accumulate cash and other monetary item, incur expenses, generate income, and arrange borrowing, all substantially in its local currency. Changes in exchange rate have little or no direct effect on the present and future cash flows from the operations. Changes in exchange rate affect the reporting enterprise's net investment in non-integral foreign operation. Instead of having a daily accumulated effect, it will impact my net operations in net investment in the non-integral foreign operation. Now see, the basic purpose is that I have financial statement of my foreign operations. To make my financial statement, if it's my subsidiary or it's my associate, etc., I need to consolidate it with my financial statement, or if it's my branch, I need to include it in my financial statement. So how do I convert these foreign currency amounts into my local currency so that I can include it in my financial statement? So we'll talk about translation rule, right? What exchange rate should I apply to the various items in the trial balance of my foreign operations so that I can convert those foreign currency amounts to my local currency amount? So first let us talk about balance sheet items. We are talking about assets and liabilities, right? So if it is a monetary item, we will use closing rate, right? For integral and for non-integral, I need to use the closing rate, that is the rate on the balance sheet date, to convert all the monetary items. But if it's a non-monetary item, here there is a difference, and here there is the only difference there in conversion. If there is fixed asset and related depreciation expense, if it is an integral foreign operation, we will use the rate on the date of acquisition of the fixed asset, or in case of revaluation, the date on which the revaluation was made. See, the normal rule was that in case of non-monetary item, we use the rate on the date the transaction has taken place. And integral, we are considering that it is our extension, it belongs to us, it directly impacts us. So the same rule which I apply for myself, I will apply it for conversion of my integral foreign operation. But non-integral foreign operation, it does not have a daily nexus with me, so I will use closing rate, right, for non-monetary items as well. This is an exception because we had learned that in case of non-monetary item, we need to use the rate on the date of the transaction. But if it's a non-integral foreign operation, right, it will affect my net investments in foreign operation, I'll use closing rate for these non-monetary items as well. For inventories, cost we will take closing rate. For NRV also we will take closing rate. See, basically the thing says that it should be the rate on the date the transaction has taken place, the rate on which various purchases has taken place, but for the purpose of convenience we are taking closing rate in this case, and this applies for both integral and non-integral as well. For opening stock we will take the opening rate in both the cases. For PL item, we'll take the rate on the date of the transaction, but to convert various transactions at that rate, using the rate on which those transaction takes place become impracticable. So for convenience, we take the average rate to convert the statement of profit and loss item. Now there will be goods sent to branch by the head office. We don't need to convert, right? When the head office will send these goods to branch, the head office will record that entry in its local currency, use the amount which is given in the trial balance of the head office. Similarly, balance of head office in the book of branch. So branch will have, let's say I have a branch in US. So that branch will have head office accounts in a trial balance and the amount will be in USD. I don't need to convert this. I will look at the head office trial balance. I'll look at the branch account, and whatever balance is there in the branch account in the books of the head office, I will use that particular amount. Now see what will happen. What I am necessarily doing is I am converting the trial balance of my foreign operations into my local currency, which is INR, and I have converted certain items at closing rate, I have converted certain items at average rate, I have not converted certain items, and I have taken the amount which was appearing in the HO book. So since there is no consistency in converting various items, definitely the trial balance will not match. There will be a difference in the trial balance. In case of integral foreign operation, like the difference will be taken to statement of profit and loss as exchange translation gain or loss. But if it's a non-integral foreign operation, will not hit the PL. The difference will go to foreign currency translation reserve to be disclosed in the balance sheet under the head reserves and surplus. So there are two major differences, please note. In case of translation of fixed asset, in case of integral foreign operations, we will take the date on the rate on the date of the transaction, whereas for non-integral we will take the closing rate. In case when the trial balance will not tally, that difference in integral it will go to PL, in non-integral it will be accumulated in foreign currency translation difference. When that non-integral foreign operation will be disposed of, right? When maybe subsidiary is there, I sell off that subsidiary. Right? Whatever balance is there in the foreign currency translation reserve account, right, which I have taken and not taken to the PL and I have deferred, right, will be recognized as income or expense in the statement of profit and loss. So on ongoing basis, you will not hit the PL, you will accumulate the difference, and when that particular operation is sold off, that entire difference, be it a credit balance or a debit balance, will hit the statement of profit and loss. But if partial disposal is done, maybe I am holding, let's say, 50% in a particular thing, I sell 25%, remaining 25% is with me, right? In case of partial disposal, only proportionate share of the FCTR will be transferred to PL. So maybe there's a balance of 100 in my FCTR and I have sold 50% and 50% is still left with me. 50 will be transferred to PL and 50 will still remain in the FCTR account. Now we'll talk about change in classification. Initially a foreign operation was considered integral. Now we are considering it as non-integral. Or it could be a scenario, initially we were considering a foreign operation as a non-integral foreign operation, and now we are considering that foreign operation as an integral foreign operation. See the entire disconnect. Listen to this very carefully. When we did that exercise of conversion, we saw that there were two places where there was difference. First in case of fixed asset and another in case of how you deal with your difference in the trial balance. See, you are classifying your integral into non-integral. In case of integral, you used to use the for fixed asset the rate on the date of the transaction had taken place, that the historical rate. But non-integral you restated at the balance sheet date, right? So exchange difference arising on translation of non-monetary asset at the date of reclassification are accumulated in foreign currency translation reserve, right? So for example, your asset, your fixed asset was worth $10,000. You had purchased these when the rate was 60 and they were appearing in your balance sheet at 6 lakh. Now when you are reclassifying it as non-integral foreign operation, so you will have to convert this $10,000 into INR using the exchange rate on the date when the reclassification is done. So maybe the exchange rate on the date of reclassification was 75. So now these fixed asset will appear at 7,50,000 and this 1,50,000 of difference will go to foreign currency translation reserve, right? Foreign currency translation reserve. Similarly, when you are converting your non-integral to integral, see in case of non-integral you restate your fixed asset at the closing rate at each balance sheet. In case of integral you don't restate, right? So they are saying that whatever value the fixed assets are appearing in the trial balance of non-integral operation, which is obviously the restated value, consider it as a historical cost and carry it forward in your balance sheet. And when you are converting your non-integral into integral, in case of non-integral there will be a balance in foreign currency translation reserve. In case of integral, all the differences go to PL, so there is no foreign currency translation reserve. So you are saying that foreign currency translation reserve will not be taken to the PL. Even if you have reclassified non-integral into integral, it will remain in your balance sheet, right? So the translated amount of non-monetary item at the date of change are treated as historical cost for those items in the period the change and in the subsequent period as well. So whatever value the PP is appearing on the date of reclassification, that becomes its historical cost. Exchange differences that have been deferred in the foreign currency translation are not recognized as income or expense till the time the operation is disposed of. So once you have transferred it into FCTR, don't play with it. Only when the operation has been disposed of, you will take it to the statement of profit and loss. Now we'll talk about forward exchange contracts. See, there are two purpose for which you enter into a forward exchange contract. One which is for the purpose of hedge, another is the purpose for speculation. I'll give you an example. Let's say I purchased goods worth $10,000 on, let's say, 25th March 2020, when the dollar to INR rate was for $1.75. Creditor to be paid on 25th May 2020, right? So when I purchased, right, these goods, I will record purchase account debit to creditor, which is 10,000 into 75. Now I have to make the payment to the creditor on 25th of May 2020, which is after 2 months. I don't know what will be the exchange rate after 2 months, and if the exchange rate becomes too adverse, it may cause significant loss to me. So I am not too much an expert in these foreign currency rates, etc. So I need to protect myself from foreign currency fluctuation, right? See, on 25th of May, what I need to do? I need to purchase $10,000 from the bank and make a payment to my creditor. So on 25th of March 2020 itself, on the date I have made my purchase, I will go to my bank and I will tell the bank that, bank, I need to make a payment of $10,000 on 25th of May, which is 2 months from now. Right? But I want to make a contract today for purchase of these $10,000 from you. Tell me the rate at which I can buy these $10,000, right, on 25th of May and make the payment to my creditor. So the bank told me that you can buy these $10,000 at 78 per dollar, right? Today the rate is 75. The bank is telling me we will sell it to you at 78. We are expecting that the rupee dollar price will be adversely functioning and the exchange rate will increase, right? So I know that I will be making a loss of 3 per dollar, right? 3 per dollar, and into $10,000, my total loss of fluctuation is 30,000. So I tell the bank, okay bank, freeze the contract on 25th of May 2020. I will purchase $10,000 from you and I will pay you 7,80,000 at the rate of 78. So now I can have peaceful sleep. Now even if the exchange rate becomes 80, exchange rate becomes 82, exchange rate becomes 85, it's not my worry, because I have a right to buy these dollars at the rate of 78. So I am limiting my loss. What am I doing? I am limiting my loss. I know at the very inception that how much of exchange difference loss I have to bear. It could work reverse as well. Maybe the rate could become 72, right? So if had I not entered into this contract, I could have purchased the dollar at 72 and saved a lot of money. I buy it at 75 and then I could make the payment at 72, but then I need to be expert to make this prediction. So I am happy with a loss of 30,000 and I protect my position. This is basically known as a hedge. What is this known as? This is known as a hedge. Another purpose for which this same deal could be done is for speculation. For example, there is no purchase. I know that the USD dollar rate might be adverse, and to get the difference in the rate, to profit from the difference in the rate, I may enter into a forward exchange contract. This will be known as for the purpose of speculation, right? So what is a forward exchange contract? It is a contract, or it is an agreement to exchange two currencies, right, at a future date but at a specified rate. Because I am exchanging $10,000 with INR at a future date, which is 25th of May 2020, but at a specified rate, which is $1 is equal to 78. So foreign exchange contract means an agreement to exchange different currencies at a forward rate, and this forward rate is basically 78. For what is a forward rate? It is a specific exchange rate for exchange of two currencies at specified future date. In our example, the specified future date is 25th of May 2020. And then we have already seen what are the purpose for which the foreign currency forward exchange contract could be entered into. Forward exchange contract can be entered to establish the amount of reporting currency required or available at the settlement date of the transaction, which is for the purpose of hedge. We know that we need 7,80,000 rupees on 25th of May 2020 to make settlement to my creditor. That if I keep it open, it could be any amount. Intended for trading or speculation purpose, to make profit out of fluctuation in foreign currency rates. Now let us talk about the treatment. See, today, when I entered into the transaction, when I purchased, the rate was 75. I made a contract to purchase $10,000 after 2 months, and the rate which was quoted to me was 78. So something which is worth 75 today, I am entering into the contract to purchase the same thing at 78. See, the alternative could be, listen to this very carefully. Today itself I could have purchased $10,000 and paid at the rate of 75, 7,50,000. But in that case, I need 7,50,000 today, na? Maybe the cash is not available. Maybe the cash will be available after these goods are sold, and that therefore 2 months of credit, right? And therefore I book a forward contract. So this 3 which I am paying extra, see the difference between 75 and 78 is 3 rupees per dollar, right? This is known as my forward premium. What is this known as? This is known as forward premium. I am paying this 3 extra and not executing and buying the dollars today, right? And trying to buy it at a future date. So it says the premium or the discount arising at the inception of the forward contract should be amortized as an expense or income over the life of the contract. So the life of the contract is 2 months. I am paying 30,000 extra. So 2 months, 30,000. Right, 1 month, a certain number of days are in current financial year, certain number of days are in next financial year. So I will break this 30,000 into number of days in the current financial year and number of days in the next financial year and record the expense. Exchange difference on such forward contract is also to be recognized in the statement of profit and loss. If I cancel this contract or if I renew this contract, right, any income or expense should also be recognized in the statement of profit and loss. But in case I am doing it for speculation, please remember premium or discount on the forward exchange contract is not recognized separately. I just have to do a mark to market for these contracts when I have taken it for speculation. Means I will look at the rate at which I have entered the contract. I will look at the rate at different point of time, at the balance sheet date, at the time of settlement, and the difference profit and loss will only be recorded. The gain or loss on such forward exchange contract is recognized in the statement of profit and loss. If you make a gain, it will go to PL. If you make a loss, it will go to PL. Exchange gain or loss on such forward contract is computed as forward exchange rate at the reporting date for the remaining maturity less forwarded contracted exchange rate. For example, let's say on 31st March the rate is 77 and the rate at which I have contracted is 75. So the difference 2 will be either the gain or loss which I need to record in the statement of profit and loss. And in these cases I will ignore the premium or the discount element. Disclosures, you need to disclose what is the amount of exchange difference that you have recorded in your financial statement, how much amount you have accumulated in your FCTR account, and you need to also show a walk that what was the opening balance in FCTR, how much additions have been made, what has been utilized if you have disposed of your foreign operations, and what is the closing balance. When reporting currency is different from the currency of the country, maybe in India all of us make financial statement in INR, but in India if I am making my financial statement in USD, my reporting currency becomes USD because it's the currency in which financial statement are made. I need to disclose the reason why I am using a different currency than the currency of the country in which I am domiciled. Any reason for change in the reporting currency? I was using INR, now I have shifted to some other currency, then what's the reason for the change? If I am reclassifying my significant foreign operation from IFO to NIFO or from NIFO to IFO, I need to say what is the nature of change, which is IFO to NIFO or NIFO to IFO, reason that I have made the change, what is the impact of the change, and what is the impact on the statement of profit and loss. By this we are done with the entire revision of accounting standard 11. We'll move on to certain practical questions. Let's come to question number 1. It says Opportunity Limited purchase an equipment costing rupees 24 lakh on 1/4/15 and the same was fully financed by foreign currency loan payable in 4 annual equal installments. So it's a 4-year loan. We say that it is long term foreign currency monetary item. Exchange rate of $1 was 60 and 62 on 1/4 and 31st of March 16, which is the year end. The first installment was paid on 31st March 16. Entire difference in foreign exchange has been capitalized. You are required to state how this transaction is to be accounted for. So, see, here we have taken a foreign currency loan, and with the help of this foreign currency loan, we have purchased a depreciable fixed asset, which is my equipment. So, here I have two options, either to go for a normal route. If I take the normal route, the entire exchange difference will go to the statement of profit and loss. Here I have an option to adopt para 46 or para 46A. If I adopt this para 46, 46A, right, the exchange difference in relation to the loan, which is long-term foreign currency monetary item, right, the exchange difference will be added or deducted to the cost of the asset, and it will be depreciated over the remaining useful life of the asset. So AS11, exchange difference arising on reporting monetary item at rate different from those at which they were initially recorded during the period should be recognized as an income or an expense in the period in which they arise. We normally, when we answer the questions on accounting standard, first we state the text from the accounting standard, then our analysis of the case, and then the conclusion. Then it says that enterprise has an option to deal with such exchange difference by para 46, 46A, exchange difference on long-term foreign currency monetary item, right, insofar as they relate to acquisition of depreciable asset, can be added or deducted from the cost of the asset and should be depreciated among the useful life. So since they have capitalized, they have done correct because they have adopted the option under 46A. So repayment of the loan is for $40,000, $10,000 have been repaid and $30,000 have been recasted. So this is the total amount. Initial recognition was done at 24 lakh. If you multiply 40,000 into 60, you will get 24 lakh. There is this exchange loss of $1 lakh. Right, it says if the company exercises option, then this exchange of 1 lakh should be added to the cost and amortized over the useful life. Alternatively, if the option under para is not exercised, then the exchange difference should be taken to statement of profit and loss. So what we are saying is what the enterprise has done is correct, but if it does not want to avail this option, then it has to take it to the statement of profit and loss. Then question number 2. Goods purchased on 1st of January 19, $15,000 worth of goods, and the exchange rate is 75 on that date. At the year end date, the exchange rate is 74. Date of actual payment, the exchange rate is 73. So here the exchange rate is falling. So it is beneficial for us because our liability towards the creditor is decreasing. You are required to ascertain the loss or gain to be recognized in the financial statement. So we will state the paragraph from the standard which you can read. See, on 1/1 the exchange rate is 75, so this is the value at which it is recorded. On 31st March it is 74, so this is the restated amount, so there is a gain to the extent of 15,000. And then now the opening balance is the closing balance of the previous year. We did a settlement at 73, so much money went out, so again there is a gain of 15,000 rupees. Question number 3. Rao Limited purchased plant for $1 lakh on 1st February 16, payable after 3 months. So 1st February the purchase has been done and it is payable after 3 months, means March, April, May. It is payable on 1st of May. Company entered into a forward contract for 3 months at the rate 49.15. So see, this is not for hedge. This is to establish the currency which is payable, right? Because there is an underlying transaction in this case. So it entered into a 3-month forward contract which it got at 49.15. Exchange rate per dollar on 1st of Feb, which is the date of the transaction, is 48. So the difference between 48.85 and 49.15, which is 30 paisa, is the forward premium which the enterprise has paid to protect or hedge itself. How will you recognize the profit or loss on that contract? So we'll state the text from the standard. We will say that the forward rate is 49, the spot rate is 48.85. So this is your forward premium per dollar. There is $1 lakh and 30 paisa per dollar. So 30,000 rupees is your total forward premium. In financial year 15-16, right, we have Feb and we have March. In financial year 16-17, we have April, because on 1st of May the settlement has to be done. So this 30,000 will be apportioned between financial year 15-16 and 16-17. 2 months will be for financial year 15-16 and 1 month will be for financial year 16-17. So 20,000 in 15-16 and 10,000 in 16-17. Then question number 4. Mr. A bought a forward contract for 3 months for USD 1 lakh on 1st December at $1 is equal to 47.10 when the exchange rate was 47.02, right? So it has purchased a forward contract. It has a right to buy 1 USD at 47.10 when the spot rate is 47.02. On 31st December, when he closed his book, the exchange rate was 47.15. So see, the exchange rate increased. On 31st January, he decided to sell the contract at 47.18. See, he has a right to buy dollar at 47.10. So he will buy dollar at 47.10 and he can sell the dollar at 47.18. So 8 paisa per dollar he is making a gain. Show how the profit on the contract will be recognized. See, here there is no underlying transaction, right? He's doing just for speculation because there is nothing being said that he has entered into the transaction, and to cover that transaction he is entering into this contract. So it is for speculation. In case of speculation, we don't calculate the premium or discount. We just see the difference between the rate on which the contract is entered and the settlement date or the restatement date, and recognize the profit and loss. So here what we will say, that we sold this contract at 47.18 and we entered this contract at 47.10, right? The difference is 8 paisa per dollar into 1,08,000 rupees. The above gain should be taken into statement of profit and loss. And if you want, you can also do it financial year wise. 31st December, right? 31st December, they are saying the rate was 47.15 and it has purchased it for 47.10. So 5 paisa of gain would be recognized on 31st December, and then 47.15 and the rate at which he has settled the contract is 47.18. So remaining 3 paisa will be in next financial year. If we add these two, this will be 8 paisa into 8,000. They haven't asked us to do financial year treatment, so the total gain on the contract is 8 paisa, which is $1 lakh into 8 paisa, 8,000, and the entire thing will be taken to statement of profit and loss. Then there is some question which is normal. This question is very important. Look at it. This question might come and it's very easy to attempt. Classify into monetary and non-monetary. Share capital will be treated as non-monetary. Trade receivable will be treated as monetary. Investment into equity shares is non-monetary. Fixed asset is basically non-monetary. Absolutely clear by this. So by this we are done with revision of accounting standard 11. I hope it would have enabled you to have a deep understanding of the standard and will help you in your exams. If you like this video, do hit the like button, do comment your feedback, and do subscribe the channel. It will help a lot. Thank you so much and all the best for your exams.